Hi, I'm Daniel Nicholas, and I'm a partner in the tax department of Eversheds, Sutherland.
Hi, I'm David Jervis. I'm co-head of Global Tax, responsible for the Eversheds Sutherland European tax practice.
And today we're going to talk about a couple of tax issues in M&A transactions. There's a natural tension between buyers and sellers in M&A transactions. Buyers tend to want to deduct the purchase price as soon as possible, and that lends itself to an asset deal. And sellers tend to want to maximize the after-tax proceeds, and that tends to lend itself to a stock deal. There are also a myriad different considerations and issues that need to be addressed up front, and we're going to talk about two of those today.
Thank you, Daniel. The typical tax issues which apply in domestic M&A transactions are equally applicable to international M&A transactions, but there's a whole range of other things that you need to think about, particularly in the context of European and transatlantic mergers. There are withholding tax issues, EU disclosure requirements, anti-hybrid rules, but the two in particular Daniel and I would like to talk about are issues around corporate residence, tax residence, and the controlled foreign company rules. Corporate tax residence in Europe is normally determined by the place of incorporation, but most European jurisdictions also have a place of management and control test, and if that corporation is managed and controlled, it can become tax resident in the jurisdiction where such management and control is exercised. That's high-level control, control at board level. This is a particular issue in cross-border transactions. First is a due diligence issue where non-resident directors may manage and control foreign subsidiaries. But there's two particular reasons in international cross-border M&A transactions which have to be considered quite carefully. And that is where you acquire a target and your own directors are appointed to the board, that can change the tax residency of that target. And in most European countries, there are exit charges, and an exit charge means that the target company will suffer a tax charge on the market value of its business. That can be a particular problem, particularly if, as is typical in M&A transactions, most of the indemnities speak to pre-closing matters.
Right, and from a U.S. perspective, over the years, there have been proposals to implement a manage and control standard. Right now, it's a standard of the place of incorporation that determines the corporate residency of a U.S. corporation. There are also well-developed rules that are similar to an exit tax, the anti-inversion rules and others, that make it rather difficult to change the corporate residence of a U.S. target in a tax-efficient manner.
Most European countries also have controlled foreign companies legislation. This applies where a parent company has a direct or indirect ownership interest in a foreign subsidiary, and typically that foreign subsidiary is located in a low tax jurisdiction. If the rules apply, that foreign subsidiary's profits can be subject to tax in the parent company's jurisdiction. The rules in the EU are not the same. They are different. In some countries, for example, the difference between passive income of the subsidiary and non-passive income of the subsidiary can be relevant, for example in Germany. In a number of countries as well, there's quite an extensive range of exemptions, such as the UK. At the moment, Holland is in the process of introducing CFC rules, which come into force in 2019. Ireland also is looking at what its CFC rules should be. So when looking at international M&A, it's going to be particularly relevant to look at your acquisition company, your holding company, and ensure that the controlled foreign companies legislation is considered and that works in a tax-effective way.
Right. And from a U.S. perspective, whenever there is a U.S. target with foreign subsidiaries or a U.S. acquirer, the U.S. CFC rules, which are very well developed and have been around for a long time, are always top of mind. And with the recent U.S. tax reform and the advent of GILTI income, those rules have gotten even broader.
Thank you for joining us. For more information about tax considerations on international M&A transactions and other bottom line videos, please go to eversheds-sutherland.com.